Hi candidates, welcome to another session. So in this session, I want us to discuss on the topic of employees benefits. And as far as this topic is concerned, we're going to discuss on a number of issues. Number one, we're going to define what are employees benefits. We also discuss on the different types of employees benefits. Later on, we look on types of post-employment benefit plan and basically how we account for the same. So, but to start with, we need to define what employees benefits are. And basically this refers to the various forms of consideration which are given by an entity to the employees in return of the services the employees render to the company. So basically what that means is that if you're rendering services to the company as an employee, automatically you must be given some consideration by the entity for the services which you are doing what you are rendering. And this particular employees benefit may take the form of salary, may take the form of what you refer as the shares which are issued to the employees, maybe free of charge, may take the various forms of allowances which are paid to the employees at the end of the year, and so on. So therefore, here we can say that employees benefit, these are various forms of consideration, given by an entity in return of services rendered by employees, in return of services rendered by employees. Now, in this case, we have different types of employees benefits. We can look on the types of employees benefits. So generally, we have 4 types of employees benefits. The first one is known as the short-term employees benefits. Short-term employees benefits. And these are those particular benefits which are given, or basically benefits which the employees are entitled to, and which are payable within a period of 1 financial year or within 12 months from the date the services were rendered by the employees. Good examples of this include salary which is payable on monthly basis, the wages which may be payable after 1 week or basically after 2 weeks, including the other allowances which are payable together with the salaries at the end of the month. So we can say that these are employees benefits payable within 1 year, from the date services were provided, were provided. And good examples of this include salaries and wages. So then number 2, we have what we refer as the termination employees benefits. And these are those particular benefits which are given, or in other terms, these are benefits which the employees are entitled to as a result of the entity's decision to terminate the employee's employment contract before the normal retirement date. So if the company, for example, make a decision to retrench some of the employees, those particular employees who have been retrenched are automatically entitled to some benefits. And those benefits which they are paid is what we refer as employees benefits. So we can say that these are employees benefits payable to employees as a result of employer's decision to terminate employees' employment contract, contract before the normal retirement date. Before the normal retirement date. So the other type of employees benefits, number 3, is what we refer as the post-employment benefit, post-employment employees benefit. So the post-employment employees benefit are those particular benefits which are payable to the employees after the employees have attained their retirement age, their normal retirement age, and they have proceeded for the retirement, or actually for the normal retirement. And this, in other terms, what we refer as the pension. So therefore, you can say these are employees' benefits payable after normal retirement, i.e. the pension. Pension, basically, we know that this is a benefit which an employee will be paid once an employee proceed for the retirement. And finally, number 4, we have other long-term employees benefits. And basically, this refers to any other benefit payable to the employees other than the post-employment benefit or the termination benefit. And good examples of these benefits include some benefits which the employees may be entitled to, which are known as jubilee benefits. Jubilee benefits are basically benefits which employees may be paid if the company, for example, is celebrating 10 years of operation, and maybe those employees have been working with the company for the last 10 years. So therefore, these are other long-term. These are other long-term benefits other than termination benefits and the post-employment benefits. Other than termination benefit and post-employment benefit, and good examples of this we are talking or basically we have jubilee benefits or jubilee employees benefits. So therefore, these various forms of consideration or the various forms of benefits the employees are given are entitled to as a result of the services they rendered to the company. Generally, they are classified into those 3 categories: the short-term employees benefit, termination employees benefit, post-employment employees benefit, and then we also have the other long-term employees benefit. Then from there we can proceed and look on another concept, and that is we look on something called the post-employment benefit plan. Post-employment benefit plan. Employment benefit plan, and this can be abbreviated as PEBP. So basically, this refers to any formal or informal agreement or arrangement between the employer and the employees, that once the employees proceed for the normal retirement, or basically they attain, that is, the normal retirement age, then they will be paid some benefits by the employer. And those benefits which are payable after the normal retirement, remember, is what you have referred to as what? The pension. So therefore, this is any formal. This is a formal or informal arrangement between employer and employees, that employees will be paid a pension, employees will be paid a pension employees will be paid a pension. So automatically this particular pension will be paid to the employees, or employees will be entitled to this particular pension or the post-employment benefit plan once they proceed for the normal retirement. They have attained the normal retirement age. So in this case, we have 2 types of post employment benefit plan, which may be operated by different companies. So the first one is called the defined contribution plan. Defined contribution plan. Contribution plan. So under this particular type of post-employment benefit plan, generally what happens is that both the employer and the employees will contribute a fixed amount of money at the end of each month, and that amount of money then will be transferred to a retirement benefit scheme, e.g. NSSF, which is supposed to manage that contribution. And once the employees proceed for the retirement, then it is upon NSSF to pay the pension to the retired employees. And therefore, the reason why we refer to this as a defined contribution plan is because the contribution to be made by the employer and the employee is defined. In other terms, it is known in advance. So here, as an employee, you know the amount of money which will be deducted from your pay. As an employer, you know the amount of money you're going to contribute, and then you are saying that money will be transferred to a retirement benefit scheme, and the responsibility of the employer terminates at that point, comes to an end at that point, once he has contributed his contribution, and also he has transferred that money to a retirement benefit scheme. So his responsibility comes to an end at that point. So mean that once an employee attains the normal retirement age, is upon that employee to go to the retirement benefit scheme, e.g. NSSF, and claim the pension. If the retirement benefit scheme is not in a position maybe to pay the pension immediately, is upon then the employer, the retired employee, that is the retired employee, to keep on making, or basically to make a follow-up to ensure that that pension is what is paid. So therefore, here we have said that contribution by both employer and employees is defined, i.e. it is known in advance. It is known in advance. And also here we have said that the responsibility of the employer here is to contribute, and basically once he has contributed his part, or the amount he should contribute, he takes that money to the retirement benefit scheme. And then once the employee retires, the employer do not have any responsibility when it comes to the payment of what? Of the pension. It is upon now the retirement benefit scheme, e.g. NSSF, to pay the pension to the retired employee. And then from there we have the defined benefit plan. Defined benefit plan. So under a defined benefit plan, the pension to be paid to the employee once the employee proceeds for the retirement is usually agreed in advance. So it means that once you secure a job here as an employee, you agree in advance with your employer the amount he'll pay you as a pension by the time you'll be retiring. And therefore here, it is upon now the employer to be able to estimate, or basically to be able to determine the amount of contribution he needs to be making on monthly basis, and maybe also the amount to be deducted from the salary of the employee to accumulate enough money to pay the pension which has been agreed in advance. And therefore, as we are going to see later on, in terms of how this type of post-employment benefit plan is accounted for by the employers, it is a little bit complex due to a number of factors, and actually we are going to look on those particular factors later on. So therefore, in this case, we are saying the pension or post-employment benefit plan, post-employment benefit, that is post-employment employees benefits, is defined, i.e. it is known in advance. It is known in advance. So the pension you're going to receive as an employee has been defined, has been agreed in advance. So for example, in this case, once you secure a job with a certain company, you can agree, or basically your employer can promise to pay you a pension of 5 million by the time you'll be proceeding for your retirement. Therefore, here we have said that is then upon the employer to be able to determine the amount which need to be contributed by both you as an employee and also by him to accumulate enough amount of money to pay this pension which you have been promised in advance. And basically what that means is that if by the time you'll be proceeding for your retirement, and it happens that the amount of contribution you have made as an employee, the amount of contributed by your employer plus now any investment income which is generated by those contribution is not enough to pay this 5 million, then the employer has a responsibility to come in and basically cover the shortfall, or actually top up the deficit. If maybe the amount contributed plus the investment income earned is around like 4 million, it then means that the employer has a responsibility to come in and top up the deficit of 1 million. So therefore, in that case, we have those two types of what we refer as the employees benefit. Majorly, this particular topic here, what you need to know is how to account for these two types of employees post-employment benefit plan. But even before we look on how we account for the defined contribution plan, the defined benefit plan, I want us to look on the definition of various terms, which basically we're going to come across in looking on how we account for these two types of post-employment benefit plan. So we need to therefore define various terms to look on definition of various terms. So the first term is called, or the first term is funding. So when we talk about funding, this is basically the process of transferring the contribution made by both the employer and the employees to a retirement benefit scheme. So therefore, we can say that this is the process of transferring contribution made by both employer and employees, employer and employees employer and employees and employees to retirement benefit scheme or a plan, e.g. NSSF. And usually this is the responsibility of the employer. The employer has a responsibility to transfer this particular amount of money to a retirement benefit scheme. And actually this should be done once the month has come to an end. The employer has contributed what he needs to contribute, and also the employer has done the same. That money has to be transferred to a retirement benefit scheme. So that process we refer to it as as funding. Now the other term here is something called the plan asset. So the plan asset, generally, these are those particular assets which are owned by a retirement benefit scheme. Generally, it is important to note that once this retirement benefit scheme receive this particular contribution made by the employer and the employees, that money is not kept somewhere or is not kept in the bank account lying there. So the retirement benefit scheme is supposed to invest this amount of money such that it will be generating some income which then will be used in terms of paying pension to the employees who have already retired. And as a result of the retirement benefit scheme making those particular investment, for example, it can invest in government securities, it can invest in real estate, and so on. It will be owning a number of plan assets. Those particular plan assets are the one we refer to as, or those particular assets are the one we refer to as the plan assets. So therefore, we can say that these include number one, long-term, or basically we can say assets. Assets are held, or in other terms, assets owned by retirement benefit scheme or plan. And number two, qualifying insurance policies. Qualifying insurance policies. So when talk about these insurance policies, they are insurance policies which are procured by retirement benefit scheme, whereby the retirement benefit scheme will be making some regular contribution, like contribution, it will be contributing on monthly basis, and those insurance policies are supposed to mature, say after 5 years or 10 years, whereby the retirement benefit scheme will start receiving some lump sum, which then will be used in terms of paying pension to the employees who have already retired. So those particular qualifying insurance policies, they're also considered to be part of the plan assets. So the other term is something called the funded scheme. Funded scheme. So when talk about the funded scheme, these are type of post-employment benefit plan, whereby once the employer and the employees have made their contribution, then that particular amount of money will be transferred to a retirement benefit scheme, which is not under the control of the employer. Or in other terms, we say that the contribution by both the employer and the employees will be transferred to an external retirement benefit scheme, not under the control of the employer. So therefore, we can say this is a scheme, or basically a plan where contribution is transferred to an external retirement benefit scheme. And this particular external retirement benefit scheme, we are saying it is not within the control. It is not under the control of the employer. A good example is like what happened in Kenya. So once we have contribution made by the employers and employees, that money usually is transferred to NSSF. NSSF is not a retirement benefit scheme, which is under the control of any employer. So then the other term, number 4, is unfunded scheme. Unfunded scheme. So under the unfunded scheme, which is now the direct opposite of this is whereby the contribution by both the employer and the employees is transferred to a retirement benefit scheme, which is an internal one, in other terms, which is under the control of the employer, under the control of what? Of the employer. So therefore, we can say that the retirement benefit scheme here is under control, of employer, is under control of employer, is under control of employer. So that is what you mean by that. So the other term we also need to define here, number 5. Number 5, we have present value of the defined benefit obligation, present value of defined benefit obligation. So the present value of defined benefit obligation, this refers to the present value of the expected future payments by the employer. So basically what you have said is that if an employer is operating what you refer to as a defined benefit plan, the employer will agree in advance the pension he is to pay to the employees by the time the employees proceed for their retirement. And therefore, what the employer expects to pay in the future in form of pension to the retired employees, then it has to be discounted to its present value and recognized in the financial statement of the employer as a non-current liability. And in that case, we refer to that as liability, that long-term liability, as the present value of defined benefit obligation. So we can say that this is the present value of expected future payments, by employer to retired employees. To retired employees. To retired employees. What the employer expect to pay in the future to the retired employees. So the other term you also need to define, number 6 here, is something known as the return on plan asset. The return on plan asset. So the return on plan asset, basically, this refers to any income which is generated from this particular asset, which are owned by a retirement benefit scheme. So this, we can say this is any income, and this income can take the form of rent, can take form of dividends, can also take the form of interest, which is generated by plan assets. Generated by plan assets. So the other term we need to define is something called the current service cost. Current service cost. So when talk about the current service cost, we say that this is the increase in what an employer is expected to pay in the future to the retired employees as a result of the employee services during the current year. During the current year. So therefore, this is increase in present value of defined benefit obligation as a result of employee services during the current year. During the current year. So the other term, number 8, is the past service cost. Past service cost. Now, when talk about the past service cost, also this is the change in what an employer is expected to pay in the future to the retired employees as a result of something called an improvement. What is an improvement? An improvement is basically where an employer decide to increase the pension he will pay to the employees by the time they proceed for the retirement, and which occurred during the current financial year. A good example is whereby you secured a job with a certain company, your employer promised to pay you a pension of 5 million, but because you have been a committed employee, you have been giving good results to your employer, then he decides to increase your pension maybe from 5 million to 8 million. So that automatically will change what the employer is expected to pay in the future to the retired employees. So that increase in what the employer is expected to pay in the future, because he has improved the pension, we refer to it as the past service cost. So we can say this is change in present value of defined benefit obligation, as a result of improvement. Improvement is whereby the employer here has decided to increase the pension which the employees will be entitled to by the time the employees will proceed for their retirements. The other term, number 9, and the last one, is vested employees benefits. So when talk about the vested employees benefits, this refers to those particular benefits which the employees have already been entitled to, meaning that these particular benefits are not conditional on the employees continuing working in the company. So it basically means that if an employee decides to proceed for retirement today, then he will be entitled to this particular benefits. So these are benefits not conditional on future employment, not conditional on the future employment, not conditional on future employment, i.e. the employees are already entitled to this particular what benefit. So therefore, these are basically some of the terms which you must be in a position to define, and also which you need to know, because you're going to come across these particular terms when looking on how we account for the two types of the post-employment benefit plan, that is the defined contribution plan and the defined benefit plan. And therefore, next, I want us to look on how to account for those two types of post-employment benefit plan. And we start by looking on how to accounting for defined contribution plan. Accounting for defined contribution plan. Recall what we said here is that when we talk about a defined contribution plan, basically there's a type of a post-employment benefit plan whereby the contribution to be made by the employer and the employees is defined. So it is known in advance. What you need to contribute as an employee, what your employer needs to contribute is known in advance. And therefore, in terms of how this is accounted for by the employer is simple, straightforward, because what the employer accounts for here is what he has contributed on behalf of all employees. What has been contributed on behalf of all employees, it is recognized by the employer as an expense in the income statement. If the employer happens to not to have contributed a certain amount of money at the end of the month, then that is recognized as a current liability. So therefore, accounting for this is simple and straightforward. So the employer recognizes, or basically account, or in other terms, you can just say recognizes the total contribution made as an expense in the income statement. So meaning that if, for example, we have a company and that company has engaged or has 100 employees, and the employer happens to be contributing an amount of 1080 per employee at the end of each month. So to determine the amount of contributed in a whole year, we multiply that with 12. And whatever you get here, then we are saying that this should be recognized by the employer as what? As an expense. Maybe in this case, we can just try to compute the amount now which the employer should recognize as an expense. So we're going to take 100 times 1080 times 12. So this will give us shillings 1296,000. So we are saying that when the employer is preparing the income statement, then he needs to recognize this as an expense. On the other hand, we are saying if, for example, the employer happens that at the end of the year, he may not have contributed, for example, an amount of 1 month, then that should be recognized as what? As an expense. So therefore, to account for a defined contribution plan, we are saying is simple and also quite straightforward, because what the employer needs to recognize in the financial statement is the total amount of money contributed in a certain financial year as an expense, and then any amount not yet contributed at the end of the year, we are saying, will be recognized as what? As a current liability. So next, we look on accounting for defined benefit plan. Accounting for defined benefit plan. So what is a defined benefit plan? First of all, we have to recall what we said, that this is a type of a post-employment benefit plan whereby the pension which the employees are to be entitled to, which the employees will receive after the normal retirement, is defined. It has been agreed in advance. And therefore here, we say it is upon the employer to be able to estimate the amount of money he needs to be contributing on a monthly basis to be able to accumulate enough money or enough resources to pay that particular pension which has been agreed in what? In advance. So here, or basically accounting for this is a little bit complex due to a number of reasons. So maybe first of all, we can say that accounting for this type of post-employment benefit plan is complex. Is complex due to the following reasons. Due to the following reasons. Number one, we can say that the employer here will need to make certain assumptions, and those particular assumptions which are made by the employer to be able to estimate the amount of money he needs to be contributing to raise enough resources to pay the pension which has been agreed in advance. We refer to them as actuary assumptions. Good examples of these assumptions include issues to do with early retirement. So the employer may assume that an employee may proceed for an early retirement. The other assumption may include things like the expected market rate of return, because you have said that once this money is contributed by both the employees and employees, it's not just kept idle in the bank account. It is supposed to be invested. It will be generating or it will be earning some investment income. So therefore, the employer will estimate once we contribute and the employees contribute, we invest this amount of money, how much return will that money be earning? So all these assumptions are made by the employer to be able to estimate the amount of money he needs to be contributing, and which will be enough to meet or actually to raise resources to pay the pension which has been agreed in advance. So number two is that the pension to be paid in advance, or what an employer is expected to pay in future, is known in advance. And actually that one has to be recognized in the financial statement of the employer as a long-term liability. And actually, for that to be recognized, because it's the amount to be paid in the future, then it has to be discounted on its present value. So therefore, we can say benefits payable in future, must be discounted to its present value and recognized as a non-current liability. So the other reason why accounting for this is a little bit complex is that these particular assumptions which have been made may tend to differ from the actual event. So that means that if they differ from the actual event, that may give rise to actuarial gain or actuarial losses. So we can say actuarial assumptions may differ from actual events, and therefore giving rise to something called the actuarial gain or losses. So therefore, accounting for this type of post-employment benefit we are saying is a little bit complex due to those particular reasons. And therefore, majorly in this particular topic, or most of the questions which are tested as far as this particular topic are concerned, they usually come from this area here, how to account for the defined benefit plan. And usually once you come across a question from this area, usually the examiner will require you to compute 3 items, and mostly you explain how those 3 items are supposed to be recognized or basically accounted for by the employer in his financial statement. And therefore, next, I want us to look on the items, or basically the elements to be computed and recognized by the employer as far as the accounting for defined benefit plan is concerned. Accounting for defined benefit plan. So we can say the following items, or in other terms, we can just refer to them as elements of a defined benefit plan must be computed and recognized in financial statements of the employer in the financial statements of the employer. So which are those three items? The first one is something called the net actuarial gain or loss on net defined benefit, net defined benefit obligation, net defined benefit obligation. So the other item, number 2, is what refers the net pension cost, and number 3 is the net defined benefit obligation or assets. So these are usually the 3 items which the candidates may be required to compute and basically explain how they should be recognized in the financial statements of the employer in relation to what refers the defined benefit plan. So I want us to look on how to compute these 3 items, and actually we start with the first one here. That is the net, not the net, yes, the net actuarial gain or loss on net defined benefit obligation. So first of all, you have to remember, we have said that this particular net actuarial gain or loss, or this actuarial gain or loss, usually arises because of the difference between actuarial assumptions which were made and the actual event, what will actually happen. So if there is a difference between the two, there'll be actuarial gain or what? Loss. So in terms of how we determine this, we take the net defined benefit obligation balance brought down. Balance brought down, basically this is a balance at the start of the year, or yes, brought forward. Usually the examiner will have provided that particular figure, but in the event it is not provided, what we do is that we take the present value of defined benefit obligation at the start of the year, and then to this we less the fair value of the plan asset still at the start of the year. So whatever that will give us is something called the net defined benefit obligation at the start. To this we add something called the net interest cost, and this one is computed using the market yield of high corporate bond. So usually will be given something called the market yield or the market interest rate of high corporate bonds. And that you take that rate and then you multiply that with whatever you have here. That is the net defined benefit obligation at the start. So then to this you add something called the past service cost, if any, because this one we have said it will only arise whereby during the current financial year there was an improvement. The employer decided to increase the pension to be paid to the employees in the future. So in some questions this may not be provided. So, and then to this you add the current service cost, and next we less the contribution which were paid. So how much contribution were paid by the employer to the retirement benefit scheme, and whatever you get here is the expected net defined benefit obligation, defined benefit obligation. And then what we do is that we compare this with the net defined benefit obligation balance carried down, which is now at the end of the year. So always this particular figure will be given. So we compare the two. And it is first of all important to appreciate that when talk about a defined benefit obligation, this is a liability. This is a liability. So therefore, this is the expected value. This is like the actual. So we compare the two. And here we can have either an increase or a decrease. So if this is an increase from whatever you have here to this is an increase. So basically, anytime the value of variability increases, the value of variability increasing is a loss. So therefore, if we have an increase, that is known as net actuarial loss. Net actuarial loss, an increase in the value of variability. But if we have a decrease, from this to this, we have a decrease. Anytime the value of variability decreases, that is a gain. That is a gain. So therefore, that's how we determine the net actuarial gain or loss as far as the defined benefit obligation is concerned. It's also important to note, or basically to know, how is this net actuarial gain or loss recognized or basically accounted for by the employer. So this one is recognized as part of other comprehensive income in the income statement. So whenever the employer is preparing the income statement, then the net actuarial gain or loss, this one is recognized as part of other comprehensive income. Net actuarial gain or loss is recognized or accounted for as part of other comprehensive income in the income statement. In the income statement. So let's look on how we determine the other item, which is the net pension cost. So the net pension cost, usually there is the what is recognized as an expense in the income statement by the employer, and that is determined by adding these three items here of expense. So mean that this is equal to net interest cost, is the net interest cost. Net interest cost. So to this, then we add the past service cost, if any. To this, we also add the current service cost. So whatever you get here, this one is known as the net pension cost. And actually, this one is recognized as an expense in the income statement. So we can say net pension cost is recognized as an expense in the income statement. So it's recognized as an expense in the income statement. So let's look on how we determine the third item, or the third element, and that is something called the net defined benefit obligation stroke assets at year end. So basically, to determine this, we take the present value of defined benefit obligation, balance carried down. Balance carried down here is the balance at the end of the year. And then to this, we less the fair value of a plan assets still at the end of the year, which is balance carried down. And in this case, we can get a positive figure or we can get a negative figure. So if we have a positive figure, it is known as the net defined benefit obligation. If it is a positive figure, because it means that the present value of the defined benefit obligation is more than the fair value of the parent asset. So therefore, if you get a positive figure, it's a net defined benefit obligation. But if you get a negative figure, it is a net defined benefit asset. So this one is supposed to be recognized in the financial statement of the in the statement of financial position. So we can say net defined benefit obligation. This one will be recognized in the statement of financial position of the employer as a non-current liability. It's an obligation, is a liability, is a net amount of a liability. But on the other hand, a net defined obligation, that is a net defined benefit asset. This one is recognized in the statement of a financial position of the employer as what? As a non-current asset. As a non-current what? Asset. So therefore, those are basically the three items or the three elements which need to be computed, or in other terms, determined by the employer in relation to a defined benefit plan, and basically recognized in the financial statement. So basically, we stop at that point for now. Once we come back in our next session, we're going to look on illustration questions on how to determine these three items in relation to the defined benefit obligation, or in relation to the defined benefit plan. So therefore, we stop at that point. See you in the next session.